The Fed is panicking. I'm your host, Steve Van Metre, and thanks for joining me today. A Fed reversal is imminent as fears of a massive recession cause dissent among policymakers. Let's over to the Wall Street Journal, where we hear from Fed whisperer Nick Timiraos with the headline, Fed set to raise rates by 75 basis points and debate the size of future hikes. Federal Reserve officials are barreling toward another interest rate rise of 0.75% at their meeting November 1st and 2nd, and are likely to debate then whether or how to signal plans to approve a smaller increase in December. And one of the key points here is we know that Nick is pretty accurate on his calls. We're still a ways out, but the fact that he's saying there's a hike means that he has fairly certain information that it's going to be 75 basis points, not likely more, but possibly less. We will have a very thoughtful discussion about the pace of tightening at our next meeting, according to Fed Governor Christopher Waller. Some officials have begun signaling their desire to both slow down the pace of increases, showing dissent among the policymakers, and stop raising rates early next year to see how their moves in this year are slowing the economy. They want to reduce the risk of causing an unnecessarily sharp slowdown, while others said it's too soon for those discussions because high inflation is proving to be more persistent and broad. And there is a reason for fear here, is because when you hear policymakers talk, they will say something that monetary policy hits the economy with long and variable lags. And the problem is there's no way to measure it. All of a sudden, one day we wake up and find out that all these things the Fed has done hits the economy. And let me show you a chart. They have every reason to be concerned because those long and variable lags are coming. Here you can see the Philly Fed New Orders Diffusion Index, which we talked about in yesterday's show. And now we're going to overlay the yield, the 2-year Treasury yield in red. So I want to show you that as the Fed raises rates in red, you see the red line going up. What happens is new orders or demand from the economy starts to plummet. And when it falls below the black line, it means it's contracting. Now you'll note that every time the Fed raises rates, you see 2 years rising, new order growth collapses. Every single time we see that. Now what follows is you see capitulation from the Fed, yields then falling. And what happens is new order growth continues to go down every single time. And those are those long and variable lags that the Fed is worried about. You see some of these speakers because they know if they keep tightening, the lags are going to hit anyways, and then they're going to overshoot. The worst case is they start to slow down or pause and see if all this tightening has any effect. The problem is we're already knowing the data that something bad is coming. It's too late. And we can already see it. The fact that new orders growth is contracting and we haven't even begun to pause tells us the downturn is going to be sharp and deep. Fed officials want higher borrowing costs and lower asset prices to slow economic activity. And boy, they're going to get that by curbing spending, hiring, and investment. They expect that to reduce demand and lower inflation over time. And that works because you think about, somebody going out and spending as we go into the holidays. And when interest rates are low, people look and say, hey, I can spend a lot and pay it off later. There's not a big interest cost. Maybe it's even zero. But when you look at your credit card balance and you see that not only you have a balance, but maybe the rate is 20 or 30%, and you've got this big minimum payment that starts to change how you approach spending. And instead of going out and spending and charging and paying off later, many people start to cut their spending back, paying cash, and work on paying those credit cards down out of fear that rates will go even higher and crush their budgets. And here we can see just that happening in the retail sales data. So we have advanced retail sales in blue. We'll keep the U.S. Treasury 2-year security yield in red. And notably, when we see a rise in yields, what happened eventually, it stalls out retail sales and they start to head lower on a year-over-year rate of change. We note again, yields rising, retail sales growth slowing. It happens every time, and it's happening now. But when yields go down, guess what happens? Retail sales continue to fall. Again, those long and variable lags. Fed policymakers face a series of decisions. First, do they raise rates by smaller than half a point increment in December? And if so, how do they explain to the public that they aren't backing down in their fight to prevent inflation from becoming entrenched. And this one's really easy because the Fed doesn't really have to explain to the public much. All they have to do is, for the most part, say, we believe that inflation is going to come down in the future, and then cross their fingers and hope it does. Or they can even suggest that they believe the incoming data is going to suggest that inflation will fall. And there's a lot of evidence to show that it will. And it's not unusual for the Fed to actually pause before inflation cools off. Here you can see on this chart the consumer price index in blue. We overlaid the federal funds rate in red. And here you can note kind of in the 90s when the Fed started cutting, you see the red line going down. We see the inflation, the blue line, continue to go higher. Here you note that just after 2000, they started to pause and inflation stayed elevated, no problem. We can see other times going now late 2018, the Fed started to pause, inflation remained high and then cooled off. So the fact that they could pause now is actually not a big deal because they could say, we believe inflation is coming down, and remind you that the Fed meets before the inflation data comes out in November. So it's possible in November we'll see inflation cool, and likely we'll see in December, because we know there is a strong relationship between gas prices and the consumer price index, and on a year-over-year rate of change, gas prices are coming down. So it just suggests to us that at some point inflation should come down, and that will open the door for the Fed to actually pause, perhaps this in November, maybe at the earliest, but if not, they should be able to pause in December, but by then it's probably too late. But one thing is not too late is for you to sign up for the Traders Summit event coming up. It is still free. Here's the good news. Even though it is live, and Tracy, Shoe Chart, Jeff Snyder, and I will be live on Sunday at 10:45 a.m. Eastern. If you can't make it, it's pre-recorded. You get to register. It's totally free. They'll send you all the links for all the recordings. And those that are signed up, I got told today, will get a whole list of discounts and promos from all the people that are being part of the event, including Jeff, Tracy, and I. Let's continue on. Because markets rallied in July and August on expectations that the Fed might slow rate rises. That conflicted with the central bank's goals because easier financial conditions stimulate spending and economic growth. The rally prompted Fed Chairman Jerome Powell to redraft a major speech in late August and disabuse investors of any misperceptions about his inflation-fighting commitment. Now, the question we should be asking is, do rate cuts lead to higher stock prices? Because that's the belief. You hear that all the time. You see that in the news. Hey, the Fed's going to cut. Stocks got to be bullish for stocks. But is it? Well, no. It's not at all. Here you can see the Wilshire 5000 in blue, the total U.S. stock market against the federal funds rate. And notably, you see the Fed cutting and stock prices falling. You see that happen every time. And again, you have to ask yourself, why does this relationship happen? Why is lower rates lead to lower stock prices? Again, it's those long and variable lags of monetary policy that catch up to the economy. And all of a sudden, that leads to increased layoffs. The Fed is cutting, but remember, cutting rates does not create jobs. It takes time because, again, those rate cuts, they too have long and variable lags. The Fed's policies work through financial markets, albeit slowly. Changes to the anticipated trajectory of rates and not just what the Fed does at any meeting, can influence broader financial conditions. And now we get to the actual reason why rates keep driving higher. It's because the Fed is saying that they're going to keep raising rates. The market has picked out the terminal rate or the peak rate to be 5% of the federal funds rate. Currently, we're a bit less than that. So let's take a look at where we're at now and see what's about to change. So at the last meeting, the committee decided to raise the target range for the federal funds rate to 3 to 3.25% and anticipates that ongoing increases to the target range will be appropriate. So what's happening is the market interprets that to say, hey, there's going to be higher rates in the future, but let's just say we get a 75 basis point hike that takes us to 4%, and then we know the CPI at some point comes down, possibly at the starting the November print, maybe by December. Now we put the Fed in a pause position. What does that mean for the bond market? Well, it means it overshot the Fed, and that sends rates coming way back down. Here you can see 2-year Treasury yields against the federal funds rate, 2 years being in blue, the federal funds rate being in red. And notably, when all of a sudden the Fed starts to pause, what do you see? You see 2-year yields start to come right back down the moment they realize, and you can see going into 2018, 2-year yields had it wrong. They overshot the Fed, came screaming back down, and now we're way above that, again, suggesting the market probably has this wrong. And some officials said they want to see proof that inflation is falling before easing up on rate increases. Given our frankly disappointing lack of progress on curtailing inflation, I expect we'll be well above 4% by end of year, according to Philly Fed President Patrick Harker. Although I think he might be wrong. Meanwhile, Fed Vice Chairwoman Lael Brainerd and some other officials have recently hinted at unease with raising rates by 75 basis points. Other colleagues are concerned about the danger of raising rates too high. And that Chicago Fed President Charles Evans said he was worried about assumptions that the Fed could just cut rates if it decided they were too high. And that is a key point, because if the Fed ends up cutting rates immediately after raising them, what does it tell you? That they made a mistake. It cuts into their credibility. They don't want to do that. That's why you're starting to hear this dissent of them saying, maybe we should slow this down a bit. Maybe we should take it easy. Let some of these lags catch up, because if we're wrong, we start to cut, and that means it's too late for the entire economy. Kansas City Fed President Esther George also last week said she favored moving steadier and slower on rate increases. A series of very supersized rate increases might cause you to oversteer and not be able to see those turning points. Again, you're starting to hear this fear in the Fed members, and there's good reason. But the problem is the ultimate result is likely to come down to what Mr. Powell decides as he seeks to fashion a consensus, and that's really what a lot of people don't know about the Fed. It is a board, they do vote, but the president usually gets what he wants, or she, in the case when, of course, Janet Yellen was Fed chair. The challenge here with all of this is if you start to get enough dissent, the members can sway the president or the head of the Fed, and that is not exactly what you want to see happen. You want to see the leader, the Fed chair, directing his board, in this case for Powell. So if he all of a sudden sees a lot of dissent, well, that means he's on the wrong side of his board, and he's got to pivot too, and the market will sniff that out quicker than you can imagine. And we know that a pivot is actually coming because the yield curve tells us. Here we have the yield curve in blue. Notably, when it is inverted or gets close to inversion near the black line, it signals every time that there is going to be a pause or a cut in rates. Here we can see the deepest inversion since the 1980s. The bond market telling the Fed every possible way, you've gone too far. So we can think that by December, perhaps, or even November, depending on what changes between now and then, a pause could be possible. And we know that it also means inflation is going to come down. This time we've got the yield curve inverted, it in red. When the curve starts to fall or steepen, shown inverted, that means inflation's coming down. So we already have the good indicators here that tell us the bond market knows the Fed is making a huge mistake. And again, not bullish for the stock market. Just as a reminder, here we see the yield curve in red leading, again, stock market down. In this case, if the market's already coming down this much, wait till the curve actually heads lower. It's going to drag stocks way down. So the market is telling us, everything in bond market is telling us, we're going to have a steep recession here. It's going to be ugly. It's going to be painful. And there's a good reason the Fed is panicking, because those long and variable lags are about to catch up in the next couple months. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.